So, Ekta, the India story has been playing for some time. What are your thoughts on it?
See, what has really happened in India since 1991 after liberalization, of course, it has been in the spotlight in the world because a lot changed for us when that happened. But what has happened in the last 3-4 years is significantly different from what was happening previous to that. So till now, the India story was about the demographics, about the internal consumption and all. What has happened over the last 4-5 years is that because of the steady government, because of a lot of other factors, I'll list them down in a while, the outlook of the world towards India is changing now. The world is taking India seriously now. Okay. The businessmen are, what happens when the attitude shift happens? The businessmen are able to play better on the world grounds when there is a I am not lesser than anybody attitude you are doing the negotiations with. Also, another thing with this attitude shift that has happened is, okay, what is different between any developed economy and a not so developed or a developing economy? Is that it is structured. The developed economy is structured. So if you go to your the US and the Australias or developed nations of the world, you suddenly feel, oh, everything is very organized. Business is very organized. Cultures are very organized. Life itself is very organized. Now, this has happened in the economic space in India. So if you see, a lot of sectors are getting organized. What do I mean when I say it's getting organized? There were not many companies and sectors that were listed. Let's take some random examples. Hospitals. There were very few hospitals listed in the hospital space. Increasingly, hospitals are getting listed. Something very retail like namkeen is getting. We never had a organized namkeen sector. Something like the hosiery and the undergarment space, jockey. This sector was highly unorganized. It is getting organized now. Agarbatti, we might see a IPO of something as basic as a agarbatti. So when these kind of things happen in any economy, the country is shifting gears. And that is why we are on the verge of becoming the third largest economy in the world. So the India story is here to stay. This does not happen, though we feel that, there has been a lot of rundown in the last 6-7 years. Returns ban gaye hain. But the India story has just started. There are many sectors which are waiting for, to unwind. There is a lot happening in the SME space. And there is a lot of interest from the world in our economy. So it is rather the beginning of, and internal consumption and demographics still continues to be our strength. So that will ensure that we are on the path of growth, and internal consumption will always ensure that we are never dependent on any external factors any longer for our growth. So the India story is here to stay, at least for this decade. It will continue even after that. But for this decade, it is going to be as powerful a story as it was in the previous 4-5 years.
What should be the approach of investors in the year 2025?
I think that's an interesting question because while the India story, as I explained, the India story is in continuation, it's going to do well. But there have been shifts in the way, as I explained, in the way the economy has. So from a demographic advantage to a fact that the entire economic space is getting organized. So of course, the investment space is also very, very, how do I put it? It's very fungible right now. It will have to be very, very flexible. I can explain this with a few examples, okay? So till about 2019, the Indian stock markets, in fact, till about we ended till the pandemic ended in India, the Indian story started unfolding in a big way after the pandemic. But will what applied in the last 3 years with investment continue to apply in the next 3 years or the next 5 years? On a broader spectrum, yes, the story will continue. But at the investor level, the investor will have to be mindful about quite a few things in this sphere of growth. Like if you see in the last couple of months, the markets have been slightly volatile. We have already seen a 10% correction from the tops. What will this mean for the investor? One, the investor will have to remain calm. But the good news is that yes, the Indian investor is maturing and he is calmer. He is not going out and selling that randomly like it used to be in the past. So yes, there is some maturity in the investors, but it will be important for the investor to one, remain calm, to keep seeking guidance. Stock markets and mutual funds are not a click away. It is not going to work that unlike the previous 3 to 5 years where everything just ran up and we saw good run in the IPO segment, in the NFOs of mutual funds, and everything was just giving you upwards of 25-30% per annum. I feel there is going to be more. There are going to be breaks on those kind of returns. So there will have to be more method in the mess now. There is going to be some volatility because you can't have a one-way market. So there will have to be some method in this madness. How do you apply method? I think seeking guidance will be very important. Investors, when the going is good and when everything is running up, it is very easy to just click something and buy it. But going forward, I think seeking guidance from good investment counselors or good wealth managers will be essential, because otherwise the investors will again land up not getting the benefits of compounding, which come only after a period of 4 to 5 years. See, what happens is that investors take advantage of run-ups. It gets different after that, because after every 2-3 years, if there is some correction or if there is some volatility, the investor either makes the mistake of exiting the market or makes the mistake of continuing with the same style of investments like that in the run-up. It is time to seek some guidance. It is time to understand which sectors will do well, which style of investment will do well, which fund managers will do well. See, there will be some fund managers and some funds which will be like, the fashion of the season. So you'll have a fund which has given extraordinary returns for the previous 3 years. Is it going to continue in the years to come? What is it that is going to change in the portfolios if there is volatility? Okay, these kind of questions are not a click away. They need more, it's a science. They need more understanding of the fund manager style of investment of the portfolio. So if you can do that, fantastic. And if you can invest time, but if you are, suppose you are an IT professional or you are a doctor or you are into full-time profession, which is apart from investments, then can you really spare that kind of time to understand these factors? Because they will become important in this cycle of investment.
What are some of the common things that the investors need to keep in mind during investing or asset allocation?
As I said, when the going is good, all the funds, all the stocks you pick up are going to suddenly give you good returns. So everything boils down to two things in investing. One is go back to the basics. So go back to the basics. The basics are asset allocation is the key. So if in this run-up your equity allocation has really changed because of the fantastic returns, or because you invested, came out of other segments and got into equities. If your portfolio is tilted more towards equities, it's time for proper asset allocation. I'm not saying book profits, I'm not saying redeem, I'm just saying go back to the basics, so the right asset allocation. Now here I like to make a point. People generally come up with, because of this new Insta world and this new social media world, people feel that, make one fit all works. But according to me, investing is a very, it's a very personalized thing. And there's this very interesting book called Psychology of Investing, okay, which says that every investor invests according to his own history or according to his or her own psychology. Now, this is very true, and we really don't understand this in the short run. But every investor has a different, yes, returns is what everybody is chasing. But in that, the risk profiling is very different. The return expectation, the tenures, these are the basics. These are the basics of any financial planning, whether it is what is your risk appetite, what is the tenure you're looking at, what is the kind of asset allocation which will suit your psychology or your style of investment. It'll again become very, very important. Random selection of funds based on past returns. So again, it's the tagline of every mutual fund is past performance is no guarantee for future performance. So it's time to realize and go back to that disclaimer, because that disclaimer was always there, but it will become relevant in these markets. So investors will have to go back to the drawing board and go back to their financial planners, go back to consultants, wealth managers, and understand their right allocation, understand the right style which is going to work in this remaining part of this decade. The fund managers who have been consistently delivering returns, and also understand the things to do in these kind of volatilities, whether it is about staying calm, whether it is about staying invested, continuing the SIPs. So these are some common things. Everybody is talking about it, but yes, increasingly they will have to understand that stocks and mutual funds are not a click away. There is more method to it than the social media suggests.
What do you think is the right process to select a good mutual fund?
If I go by the common understanding of anybody and everybody, it's like select the top performing fund in that category, whichever category it is. So as I said previously, one, asset allocation will be the key. Two, the investor will have to understand, do the risk profiling with their investment planners, and accordingly choose the right category of fund first. So that is the foremost. So the first is to do the asset allocation. Second, according to your asset allocation, to select the right category of mutual funds. Okay. And to understand that which style of investment is going to work in the coming times. Okay. Now, this is not going to be available on the on any of your social media platforms or any. You will have to sit back with your investment planners and do a proper review of your portfolios and understand where and what style needs to be changed in the portfolio. One is that. Two, I feel a very common thing that investors largely do is that they'll end up selecting the best performing mutual fund of the year, whichever category it is. If it's a mid cap category, large cap category, multi cap category, small cap category, or it's the various factors that are doing in the market, whether it is momentum, whether it is value. Generally, investors just pick up the top performing fund. I have a different approach to this, and I have a reason for having a different approach to this. Rather than selecting the top performing mutual fund, see what happens is, suppose a fund is suddenly becomes a top is the best performing fund of the country. Because everybody wants the best performing mutual fund, there is too much money chasing too few stocks, because eventually in every fund manager's portfolio there are few ideas which are doing better than the other. Okay, so when there is too much money coming into that fund because it's the best performing fund, what happens is that there is an automatic inflation created in the fund and in those stocks which are his best performing ideas. Now when that happens, there is an artificial inflation created in the overall fund in those stocks. But nothing can be overvalued endlessly. Okay, obviously there will be some overvaluation created because the entire definition of inflation is too much money chasing too few goods or too few stocks. In the next year, what happens is when the fund, everybody has come in, now the fund has reached a size and it kind of settles at that size. Now in the next year, what happens, that is where the return reflection will start happening. So very few times it will happen that the best performing fund of this year will continue to be the best performing fund of the next year. I have a slightly different approach to this. I would like to really tell my investors to again sit with financial planners, understand what's happening in each of the funds that are doing well. If it suits their style of investment, so be it. I'm not saying it's not good to be with the best performing mutual fund. Please, if it really suits your style of investment, if it's really meant to be in your portfolio, if it suits your risk profile, and what's happening in the fund, that the portfolio, the churn, whatever is happening in the fund, if that's healthy for your portfolio, no harm in going for it. But just the performance is not the best criteria to get in. I'm not saying leave performance and chase these, no. But again, as I said, there has to be some method in the madness. You can be in the third or the fourth or the fifth performing fund, may not be the best performing fund. If the gap is not too wide, try to understand what's happening in each of these portfolios. You might not understand, but seek your financial planner's guidance as to what is really happening in the portfolios and if that is really healthy for your portfolio and investment style. So one, of course, I list the 3 points down. First is you need to go back to your asset allocation. 2, you need to sit with your investor and understand your risk profiling. And 3, when you are selecting funds, I completely advocate that it's a process. It's not random. So don't do it randomly. Don't just open any website or any platform and just start selecting funds based on performance. There is more method to it than we believe.
Which asset class will outperform in the coming years? Will it be real estate, gold, equity, or debt?
If I knew the answer to that question, I would really put all my money in that asset class. See, nobody really knows the answer to that question. Okay. What has happened in the last 4-5 years, we have seen an inflation in all asset classes. Gold has done extremely well. Real estate has been doing well in different pockets of the country. Equities, of course, has outrightly beaten all of these asset classes. Debt is awaiting an interest rate cut scenario to, unfold the kind of returns that have been expected from it since a year now. So it's very difficult to pinpoint as to 25 will belong to which asset class. As I said before, the right asset allocation, do the right asset allocation, select the asset class that suits your investment style, that suits your investment psychology. I am not a believer of the fact that it's only one asset class that one should be looking at because it's the best performing. Because again, the same logic that I applied to the best performing mutual fund applies to the best performing asset class also. The next 2 years, best performing asset class might not be the best performing asset class of the years after that. So it's very important to get your asset allocation right. Not everything can go into real estate. Not everything can go into debt. Not everything can go into equities as well. And not everything, of course, will go into gold. So you need to, again, I'll emphasize, sit with your financial planner and do the right asset allocation, because that is what is going to ensure a healthy financial planning and a healthy outcome. So the real thing to understand is that whichever asset class you're talking about, whether it's the real estate, gold in the physical space, or debt and equity, the entire financial markets works on this concept of reversal to the mean. So eventually everything averages out, provided you are in good pockets in the real estate space, provided you are in good pockets in the equity or the mutual fund space, and you are in good credit space in the debt space. So eventually everything reverses to the mean. Now this is a elaborate thing which we can discuss separately, but no, I really don't think there is a definite answer to that question, that which asset class will outperform in the coming years. But equities, I feel, will continue to do well with a little consolidation here and there, because, as I said, there is a pattern which is emerging in India, where the entire economic space of India is getting organized. We will see more listings, we will see businesses which we can never imagine to be in the listed space. I gave the example of agarbatti, I gave the example of namkeens. We cannot imagine the kind of spaces which we are going to see unfolding in years to come, because the growth story will continue. So equities will continue to do well. How that really affects the other asset classes is a function of time, and time will tell us. Also, interestingly, what needs to be understood is that while equities is more domesticated, has more domesticated reasons, debt and gold are broadly linked. We cannot decouple in these two asset classes. In equities, we have seen some decoupling of India from the rest of the world. But gold and debt, you cannot decouple from the world, because largely they are interrelated. Real estate, again, is a very, I am not a real estate expert. It has done well for many. It will continue to do well. It's a physical asset. But which segment, which pockets, I think a real estate distributor or a real estate agent is the best person to take guidance from there. See, I'll again say, go back to the basics. What are the basics of investment? Don't put all your eggs in one basket. So diversification is the key. The second is that don't gamble. If you gamble, you cannot really expect the returns of investment. Even in equities, if you apply gambling as a method, the result will be that of gambling. And what are the results of gambling? That eventually you're going to take home losers. And if you're losing, you will try to double your game. Okay. So I really don't understand this asset class, because I feel it is closer to that spectrum of investment. So I like to stick to my basics of investing, and I would request my investors also to stick to the basics of investing rather than letting greed get a better of them.